Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. There were two major patterns running this market higher since July. The first has been the March to July shallowly bullish shift pitchfork. Well, this pitchfork has run its course, as 2 weeks ago the upper tine had been breached and last week it was finally broken. So in an effort to make my charts more legible, I have retired this pitchfork this week. The second pattern is more recent, is the July to September bullish shift pitchfork. In this pattern we had until these past 2 weeks seen the market channeling higher in between the lower tine, currently 755, and the middle tine, currently 825. Then initially 2 weeks ago, but more determinedly last week, the market broke up over the middle tine and has beautifully utilized the rising middle tine as the base of support for moves higher most of this week. The market is now running up into a congestion band, in reality stretching from about 845 up to around 895, all of it originating from the middle to the end of 2012. You can see how the 845 level as the low for 2012, November 2012, that has a good starting point to find as resistance for this congestion. Now, do I think this market has the strength to slowly erode the overhead resistance levels? At the moment it seems so. There's a lot of ammunition and bullish incentive below. Indeed, you'd have to drop and break the lower tine of this current bullish shift pitchfork, which is currently at 755, to even think about tempering the bullish incentive. This counts as what yesterday was not only a new recent high but also a possible shooting star pattern. Chicago corn. The market has in recent months constructed two main patterns, a sideways triangle and a descending triangle. All this I had previously discussed, but to recap, the sideways triangle was formed on the top side by the 2-pointer broken downtrend, currently at 518, from the start of July, and below by the well broken actually, indeed, July to September uptrend, with at the time its now departing partner, the long moving average, currently at 566. This had a potential target X on the downside in the 509 area, which was duly achieved 10 weeks ago. Meanwhile, the descending triangle utilized the same June to date downtrend on the top side, but then had a flat base made up from the key combination of the 61.8% absolute Fibonacci line at 525 and a 2014 high at the same level, 525. This now had an initial target X1 below in the 475 area, with a secondary target X2 in the 425 area, right on the 50% absolute Fibonacci line, which is why you can still see them labeled on the daily chart, though I will retire these after this week's commentary. So, all well and good. However, the market had some other ideas, and over the past 5 weeks prices have risen over the 61.8% Fibonacci combination, over the downtrend, and over the medium moving average, currently at 550, and most recently over the long moving average. So what did this all mean? Well, I laid out an explanation 3 weeks ago, which is still valid, and I quote, "An obvious choice would be to see the drop down to the start of September as a false break lower," and I can see the point of that. However, these markets are like life. They are usually a lot more complicated than that, and I think this may be the case here. You see, the move back up over the mid-September to mid-October period seems to have been a disguised period of indecision. Many indecisive daily reactions and counters to the previous session's moves. Additionally, over all of this, we still have had a seeming reluctance for the market to head down below the 61.8% absolute Fibonacci line and at 2414 high combination at 525. What the market saw until this week, remember this is now talking about 4 weeks ago, were prices being squished between the declining downtrend, currently at 518, and this combination of support at 525. I had repeatedly said here that by the second week of November that gap would cease to exist, and thus we needed to look to see whether this descending triangle would cause a fresh break higher or lower after the recent number of false starts. End of quote. Now, I continued 3 weeks ago with another possible scenario, and this again I quote. On top of all this, there is one other option that made itself available. It was to look at the July to date action as a possible descending wedge pattern. There is merit in this, with the lower triangle well below. That's currently at 471. And this week's move up, remember this is now talking about 3 weeks ago, being a break upwards and away from either the descending triangle or the descending wedge pattern. Hence, that's the end of the quote. Hence, 4 weeks ago, I gave some thoughts on potential targets on the upside for first the descending triangle scenario. Thus, we have initial target X3 in the 605 area with a secondary target X4 in the 641 area. I can easily see that target X4 is quite an ask, but target X3 has been and still is doable. Now, let's look at the potential targets for the descending wedge pattern. Well, unsurprisingly, the initial potential target for this pattern ties in with target X3 at 605. However, the secondary target for this pattern is lower. Target X5 for this pattern is in the 626 area. All this was fairly clear, but this week we've seen the market run into a congestion at the lesser Fibonacci line at 588, plus a lot of indecisive daily patterns. We now have an October to date based uptrend, currently at 474, which is a 2-pointer in search of a third. Yet I still suspect the long moving average below may be the core of the recent support. You see, I'm still not sure if we will break higher or drop to test the congestion around the medium and short medium moving averages. The short medium's at 549 currently. To be honest, I would like to see some more action to help clear this up. I think I'll leave it there and watch to see if this recent moves higher turn out to be true or false. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.